Hi, everybody. Welcome back to another edition of Lucia Capital Group Weekly. I'm Ray Lucia Jr., CEO of Lucia Capital Group, and I'm really happy this week to welcome Mark Scalzo to our informal panel here from my home to, Mark, I assume your home. Welcome.
I'm home. Thank you. Thanks for having me, Ray.
So just so everyone knows, Mark is the Chief Investment Officer of Volatile Investment Advisors. And, you know, we've seen you from time to time on our shows and our videos that we've sent out. And, you know, and for me, you know, I think you happen to be like one of the most experienced investment professionals that I know, and proud to have you as part of the overall Lucia family here.
Oh, thanks, Ray.
So, you know, I know you got some exciting news to share, Mark, and I know how much you love to brag about yourself, and I'm just kidding. But, you know, I just want to jump right into it. And I just want to say congratulations, because I know you and your team work really, really hard day in, day out for our investors. And you were recently honored as what they call Top Gun for several of your strategies by a group called PSN. So, you know, I know Top Gun means you're like, you know, one of the top 10 performers. But tell us what this award is all about and why we should all be so excited.
Sure. Thanks, Ray. Yeah, it's been quite an honor. What PSN is a database that many institutional managers submit their performance information to, and it really benefits larger institutions and their consultants. And it's really how they compare managers in a particular category, like a global or international strategy, and it forms the basis for them for selecting certain managers for different mandates. Most managers in that database are GIPS compliant, meaning they follow global investment performance standards, and their performance numbers are independently verified. We are in that category. Both were GIPS compliant as well as verified, and they tend to be some of the best managers in the business. So certainly being in that group and being a top gun, which means that we're top 10 for certain time periods. And let me just give you the specifics. In this database, in our category, the Validus Global strategy was #1 actually in terms of absolute performance for the first quarter of 2020, and #5 for the 1-year absolute performance through March 31st, 2020. So it is quite an honor. The international strategy was ranked #3 in terms of absolute performance for the first quarter of 2020. So we're very proud. We're not surprised. You know, we work very hard, and we follow a very strict process, and it certainly is rewarding, and it's important for us because it's the way that many asset allocators kind of evaluate us relative to our peers.
So, you know, I understand, you know, I can see the excitement in how you just told everybody you are #1 for at least the first quarter of 2020. I mean, you know, you expect it. I get it. But you're the kind of investor just like kind of like even keel kind of guy. And I think that's what I love most about you is whether you're #1 or not, whether the market is going straight through the roof or down, you know, like we saw in Q1. You know, you tend to be kind of just, hey, I follow the process, and it's the process that you've developed over the years as an investment manager. So, you know, we were in the face of this unprecedented volatility this past first quarter. So, you know, why don't you give everyone a little insight into your 5 pillars and your process and how you manage risk that has achieved this level of performance?
Yeah, and that's been really important. It hasn't always been easy to be even keeled through the last 6 months. I can assure you, Ray. But
I never see you sweat, Mark.
I think being specific is very important. What you haven't owned during this period has been just as important as what you've owned. I think it's very important, and this is our partner Joe says it all the time. You have to be able to play offense and defense at the same time, and I certainly think that's been true. And that means, again, knowing what you own versus what you don't own. Our process has always been from the bottom up. It's always been stock specific. Just to give you a brief review of our pillars, we use kind of a pillar methodology to score different individual stock opportunities, and we look at 5 things. One is knowledgeable investor behavior, and that's what really smart investors are doing with their own dollars, not analyst opinion, but real dollars going into stocks. The second one is a growth thesis. We have to have a reason for these companies to be able to grow earnings and revenue over time. The third is valuation. We don't want to buy companies just that are expensive. We want to get value even in companies that are growing a lot. So we pay attention to where we buy the companies in terms of their overall value. Financial capacity, really the balance sheet. So it's got to have the balance sheet in order to live up to its growth prospects. And so it tends to focus on the strength of that as well. And then finally, any specific risks we can identify. We score each one of those pillars and then develop a ranking system for individual stock opportunities. So during this quarter, it's been pretty intense. We've traded a lot more than usual. At times, we've held up to 25% cash in some of the portfolios. That's not really a timing call from our perspective. It's really where we see the opportunities from the bottom up. At times, things have become overvalued. At times, they become incredibly cheap. So it was really the result of our bottom up process that led us to more active trading. But it's pretty important to be active in this kind of environment.
And I bet it was pretty difficult to see a future growth thesis early on for certain companies, right?
Yeah, it certainly has been, and that's one of the things we try to.
From February to like mid-March, where everything's just selling off, right? And the world is in pandemic mode, and everything's changing. And that's kind of what I'm thinking. It's like, what are some of the things that were going through your mind? I know you have your process, but one of those is growth thesis in a world that was shut down.
Yeah, that's an interesting point. One of the things that we try to pay attention to that goes into our scoring is the sustainability of the revenue and earnings. And so obviously that leads us to focus on companies on what I like to call, and many people call, secular growth companies, which can really grow despite what the economic conditions are. And so that leads us to more recurring revenue models and more sustainability in terms of both earnings and growth that our companies tend to display, because that's how we score them. So yes, it's true that we've had less visibility than we've had in a while, and frankly, things are still kind of fuzzy even today.
So I know over the years, Mark, you've managed stock portfolios, you've managed mutual fund and ETF portfolios, and and when you watch the news, the financial news media on TV, and you read in the papers and really online now, it's amazing to see just this whole switch from not even just 90 days ago to buy the market, index-based approach, to almost everyone's talking. You got to be specific. You got to know the stocks that you own. Don't buy the market. So what do you have to say about that?
I think there's certainly, and we have felt that there's a tremendous amount of merit to obviously being specific, owning individual companies, knowing those stories. Not to say that for certain parts of the market or for certain strategies it doesn't make sense to have a more kind of generalist market approach. But I mean, there are some real advantages to focusing on individual companies and individual stocks. One is that, generally you're not buying a vehicle, you're buying the company stock itself. So you don't pay any implicit fees. The client doesn't pay any implicit fees for managing that product in and of itself. So that's a hurdle that manager has to overcome in terms of delivering performance, in terms of it getting into our clients' portfolios. Another is that you're making a judgment. Anytime you buy a mutual fund or you buy an ETF, you're making a judgment on another manager in their process. And my view has always been, would you rather spend your time doing due diligence on other managers or on companies themselves? And that leads us to having a level of knowledge about those individual companies, every company that we own, that we can share and explain to our clients if they're interested. Not many of them are interested, but we do get questions from time to time about specific companies, and we obviously have an investment thesis and can share that. And I think that's really important to understand what you own. We've always been what I call benchmark agnostic, meaning we know what's in the benchmark, but don't really care in terms of our process.
I know. This is where you had me at hello. I mean, going back, when we first met like a dozen years or so ago, right? I mean, this is where you had me at hello, which is ActiveShare. So tell everybody a little bit about ActiveShare and why they should be excited about ActiveShare, because I know you are.
Yeah, there was, there's been a number of studies. It started with two professors from Yale, probably about 15 years ago, where they looked at not only the historical performance and the volatility around that performance for a manager, but also what they owned relative to the benchmark. And what they concluded is that the more different you were in terms of your holdings than the benchmark, and the higher standard deviation of your returns, the better your performance overall over time. And that kind of makes sense. It's really difficult to beat something that you're trying to replicate. Many managers will limit how different they can be from the benchmark itself, seeing that as kind of taking risk. That's always been nonsense to me. They call that tracking error, and most of the time when we're different from the benchmark, at least historically, a lot of our tracking error has been alpha. So it's been generating excess returns. And really that's what our job is. It's not to replicate an index, it's to deliver returns for clients.
Right, and replicating an index, for those that are, if you watch TV and you read that, you'll see, someone says, well, I'm overweight technology. What they're really saying is, their index that they're benchmarked to may have X% allocated to technology, and they're X plus some percent above that on their overall weightings.
Right. And we certainly know what those percentages are, Ray, but we don't manage the portfolio to that end. Our weightings, our sector weightings, our country weightings, how much we have in international and versus US is a function of the bottom-up decisions that we make, rather than some kind of top-down macro call.
And it's those very decisions that landed you and your team on the Top Gun list for PSN this past quarter. And so once again, Mark, congratulations to you. Thank you for joining us on the show. And you had me at ActiveShare, my friend. And congratulations again. And everybody, you go ahead. You want to say something real quick before we sign off?
I just want to say thanks for always believing in what we did and what we do, and thanks for letting us share this story a little bit.
And I think it's a very important one, and we don't get a chance to brag too much. And we've been very blessed to have great money managers on our team working side by side with our financial advisors to enhance the potential outcomes for our clients, so they can achieve their goals and spend their time on what's most important, their own life's purpose, whether it be with their family or philanthropy or whatever it may be. And that's really what we're all about here at Lucia Capital Group. And again, just want to thank everybody so much for tuning in, and we'll see you next time. God bless. Take care.